So with that, I want to hand it off to Chirag and let him take it from here.
Thank you, Kavita. Thank you very much for that video back there. Also, definitely be part of the donation party. I'll help out any way I can. So, but again,
Thank you.
and then for the audience, again, thank you for taking your time this evening for joining us on this educational seminar here. And without further ado, just let's get going. Yeah, we're talking about hotel investments. Just a little bit about me. As Kavita mentioned, I've done $100 million. I've done about 15 projects in my career, 6 ground-up developments, 9 value add acquisitions. And then I still have a couple in my portfolio that we currently have and are cash flowing well. Just to give a little background about me, and yes, been in Texas for about 20, almost 30 years coming up on. But and these are just a few properties I've done. And as you can see, the Clarion to Holiday Express and Marriott product, which is the Town Place Suites. And that's me on a nutshell for my experience. I guess just moving along. Can we go to the next slide? Okay. In the aspects of for as why invest in hotels. On the aspects of a multifamily where it's similar, value add hotels, they'll have a very strong returns, but just like when you acquire a property in multifamily that's mismanaged or underperforming, or there's multiple elements that go into effect. So, but the standard, I guess, the way I look at it is that you take a property that's probably independent property, meaning there's no flag on the property, or it's a lower tier flag, to where the property can be upgraded by putting some renovation money in there. But to thoroughly explain it, yes, you buy a property to lower no flag on there, pick it up at a fair price or good deal. You put some renovation money in there in terms of far as what a franchise, when you determine what franchise you want to go with, the franchise will tell you that you need a fix A, B, and C. You go in obviously from a cosmetic standpoint, but also any renovations that need to be done. We're along on the parallel movement. We would up the as we do the renovations and get the new flag in order, we'll up the rates as well, just like you guys we would do in multifamily. That as you guys do renovations to a property, you would add update the rates, and for as rental rates for as monthly aspect for us would be from the hotel aspect, it would be on a daily night. So going from, like, example, if it's a hotel that does $30 to $40 a night to something that can do $80 to $90 a night. But of course, with that being said, getting that right, you guys have to have the right team in place as well. If the staff usually are more than half the time, we have to change that to staff as well. And that's where, what I mean by that is that from the aspects of customer service, make sure that a customer service business to able to deliver that rate. So when a customer walks into a property that's been renovated to its new flag, most of the time that's different type of clientele. With that being said, just like in a multifamily business, that your $500 to $600 a month tenant is different from your the tenant that pays $1,000 to $1,500 a month. So the same concept kind of goes in line with hotels. Customer that comes in and pays $30 to $40 a night is going to be different from the customer that comes in and pays $80, $90, if not $100 plus a night. So that being said, you want to have the team in place to make sure that they're able to provide that service, able to capture that rate from the customer, and just a different mindset. That's one element of the staff. Then renovation. And of course, in the return, which the biggest thing is return on a ROI. Um, we once you increase the we put a flag on a property. Historically, in my experience, is usually if not double, if not triple the value, practically within a couple months. Just from one because you got upgraded property in terms of new cosmetics to just layout to also on the flip side, which is the cash flow perspective. I've taken properties that done 250 to $300,000 a year to doing eight, 900,000 to almost $1 million a year. So, in which return ups the value to, I mean, hotels in this probably market right now can go for 4 to 5 times multiple. What I mean by that is what the annual revenue is, 4 to 5 times that. So if a property does $1 million in revenue, you can go for $4 to $5 million.
So I think that's the place where it's different from multifamily because multifamily is valued based on the NOI, and here you have your value is based on the multiple of the net income, right? Not the
Well,
net income, but the gross income.
yes, top line revenue.
Yeah.
So that's where a lot of guys do it now. There are guys like to go, they go off the NOI as well, and
Mhm.
I can get touch base on that a little bit later. And that's where the
Okay.
differentiation between flags comes in.
Okay. I
Uh,
think we could kind of move along to
okay.
why invest in hotels.
Yes. Okay. Um, for investing hotels, it's quicker returns. Quick returns in terms of a tenant versus a customer. We're checking a hotel. We're turning that room daily, so we're asking for a higher rate. Multifamily, of course, it's once a month or once every few months. You're emptying, turning a unit. In the hotel business, we're turning the units daily, which return we ask for a higher rate, anywhere from $100 to $200 a night. Depends on the type of flag, and on up to $300 400 a night. Just depends on the again type of flag, geography, where it's located, and
And
it.
what do you mean by the type of flag? Is that like the franchise that you're affiliated with?
Yes. So
Okay.
let's go into this a little bit later, but we have a wide array of types of flags from the economy or the budget hotels, such as Econo Lodge to uh, Independence, to all the way to the opposite side, which is full blown resorts, such as I
Yeah.
think I come to Gaylord comes and my mind right now, but
Yeah, we can talk about that. I think we have a slide on that as well.
exactly. So, um, the obviously you get the higher returns. Cash flows a little bit quicker, a little more higher than multifamily. We'll touch about this a little bit later, but double digit cash on cash returns, and along with the IRR, tax benefits with the accelerated depreciation. You can take advantage of that, especially on the renovation projects, and I guess even on new development as well. Um, and has higher cap rates in terms of just able to have it turned around in terms of get it stabilized under a new flag. And the experienced operators, and this is one thing I probably tell above all that hotels is a different investment. It does take experienced operators. I've seen it time and time again to where other guys outside the industry go step in and they'll take a good running property and go the wrong direction. And that's where I've taken over properties that way and turned the properties around. But I can tell you without a doubt that um, experience is going to have a huge factor on the obviously Operation Hotel. And I've seen properties that 100-unit properties are ran very, I guess, almost like a one-man show. And then I've seen other 100-unit properties that very well ran, like a well-oiled machine. So with the checks and balances in place to audits to a point of and to the point of a very strong image in a marketplace. So, and then of course for our investors and even myself, which means like, hey, our investment's protected. Like, hey, we have good cash flows, and then in terms of an exit, want to get down the road when we want to cash out, refinance, or sell. So, but and then as I mentioned earlier, in terms of hotel classes, um, as I mentioned, is that we get your budget hotels at Travelodge, Econo Lodge, and Roadway to the full blown resorts like a Gaylord and to the Hill Country in San Antonio. I'm thinking a couple places, and probably somewhere like Disney. My more, I guess, I like the more the mid scale area, limited service, hot comfort suites, candlewood suites, stuff like that, and extended stay. I've done a few luxury projects as well, but the sweet spot, extended stay and limited service. And the reason being is that in the hotel business, a lot of hotels do have ancillary services to attract clients, but their biggest profit margin is the guest room itself. When I say that, it's any hotelier or GM you ever meet will tell you the same. Um, but that being said, I can like the budget hotels, they're good. They're not bad. They're if they're ran, but the problem with those is, I guess, my perspective is that the rates are usually low enough that it's hard to get a higher rate. So, but
So when you look at it from, you tend to stay in the limited service and extended stay. How do they, what performs best in a downturn? Because that's something all our investors are looking at because we're headed into a downturn. So what is the sweet spot and why is it the sweet spot? Why is it the best place to stay?
well, the limited service market, as you mentioned, and I apologize, I'm trying to cut that off that notification. I don't know if everybody can hear that, but
It's okay. Yeah, we can hear it. It's all
okay,
right.
sorry about that. But yeah, so the sweet spot for limited service um, is due to the fact that it. Sorry, I'm gonna turn. I forgot to turn it off. But to answer your question, the rate fluctuation in terms of that's the biggest segment in terms of the markets. Comfort suites, candlewood suites. There are a lot of corporate travelers that use that market,
Mhm.
and then there's usually wide array of rates. I can push the rate till I've seen properties of like comfort suites push the rates of $250 a night, but on a slow time they can back down on a to the $100 to $150 a night to help accommodate low occupancy levels. On the budget hotels, that's where the struggle is that you can obtain higher occupancy levels, but your rate is going to have a cap because once you start hitting $60 to $70 a night or maybe higher, you're pricing yourself out. So an average consumer is going to say, "Hey, instead of paying $100 for a Colony Lodge example, why not go to Comfort Suites?" Now the opposite is also where the full service hotels, such as a Hyatt Regency or a Gaylord, as I mentioned before, that when the economy does go south, they're one of the first ones to go, I guess, empty in terms of not empty, but their occupancy level drops significantly.
So it's
Uh,
sort of like a class A for apartments, and then the extended stay and limited service are more like the class Bs and the Cs. And
correct.
economy kind of compares to class C.
Yes. So exactly. So Class B, it does. It's a healthier return on investment, so it can withstand the economy. I guess the fluctuations the most. In terms of like if as like I said, like you mentioned, if the downturn in the economy comes down, I've ran Comfort Suites and Holiday Express to that level, and we're able to um, drop the rates down
Mhm.
and have more incentives for guests to stay with us. And then going back to what I just said earlier, that a full service hotel is going to have a probably anywhere from 200,000 to 300,000 square foot of meeting space. A resort's going to have, like example, a water park or a theme park or a golf course attached to it. I know the Gaylord has a huge atrium, but they do all kinds of specials in there. But they've got I think nine restaurants on site. And I think every like this year, every year they do an ice exhibit. But they also, the purpose behind the Gaylord is that they have these additional services or opportunities that people spend the money, but brings a client in. In return, they can go after bigger groups, such as like throwing out there. But if Lockheed holds a conference, they'll use somebody like the Gaylord that can accommodate probably a 3, 4, 5,000 attendance conference. So, but of course, with that being said, something like the Gaylord is going to have a high overhead outside of the rooms, and that's where the margins on the restaurants to the bars is not as near as aggressive as a hotel room itself.
And
Uh,
there's also some amount of like things that, as far as a meal or a restaurant
yes.
within the hotel, that is there in some versus the other. And how is that split out?
Usually, it's split out to where the restaurant itself, it's the half the time it's leased, but um, in terms of far as how I'm trying to think how I properly word this. Um, the margins are a restaurant business. I mean, historically, has always been running about 30-40%. On a hotel, um, it's even skinnier because they've got a lot more overhead line. It's much more pricier real estate to be a part of. With that being said, the margins are not as aggressive versus a hotel room where a Gaylord does charge on average $350 to $400 a night. They've got specials going on, but they usually include the other things.
Okay.
So I hope that roundabout answers the question.
Yeah, I think we can move on.
Okay. So as I was talking about earlier, typical things we can do in value add, basic updates to get the full hotel fully operational. I've seen properties, and that's this one a similar multifamily. I've seen a 152 unit property where 25% of inventory is down for just a lack of maintenance to renovation, um, uh, whatever the case may be, and then or it could just be poor management. Uh, the rooms are being kept or updated to the current market, or what the market calls for. On the parallel movement, we would secure a well-tiered franchise that fits the hotel. What I mean by that is that you don't want to put a budget hotel in a strong demand market, um, such as okay, like I wouldn't put and I hate going back to Travelodge, but I wouldn't put a Travelodge in downtown Fort Worth and downtown Dallas because the rates are high and you're going to be the bottom of the spectrum when it comes to asking for the fair rate. But also, I wouldn't put a full scale resort in the middle of rural town in Texas or anywhere in the U.S. Because you know you're going to have you want the higher rates, but it's going to be tough to get that because there's no other attraction to bring to the people to that your property. Now, there's obviously markets that have that, and yes, you can get that. But going along with the well-tiered franchise, that's why I like the middle market, like the limited service, what I'm talking about. And go and when we secure the franchise, you do the renovations per their franchise punch list. Um, and then what I mean by that is that we got like example IHG on Holiday Expresses. They right now the requirements is I think it's 50-inch TVs with smart TV options, and the TV has to be certain inches away from I guess a nearby table. It has to be. Forget my memory serves at 48 inches off the ground. There's stuff like that where IHG is picky, but return is that they provide the reservations, they're part of the marketing, make a good investment to the um I'm sorry, into their marketing in return gives um the owners go returns on their investment. And as part of when you doing value add, when you update the franchise, put the renovations in, you want to start establishing local relationships, such as a local chamber of commerce's organizations, such as local venues to local churches. And I don't know, I was got told to ask whether why churches. Churches, they have weddings, they have reunions, they still have gatherings. A lot of, I guess, camps they have, so to speak. So people coming out of town, they need that as well. And of course, ultimately, is the as to the bottom of the slide is start building corporate relations. Corporate relations such as, and I'm not saying corporate relations just only like something like a, call center or a factory. Um, I'm going the full spectrum. Construction companies, trucking companies, to specialize trades, as far as in terms of a construction to IT specialists. Example right now, like Walmart and Sam's, these stores, these retail big box stores that are sitting in the area, they do have a need for hotels, hotel needs. Reason being is that their trainers, the management staff, usually has meetings off site. Trainers, management training and seminars to just meetings in general, they'll usually have them on site. Now, obviously, the entry level employees or the team members of these organizations are trained on site. To and also and going back to the management, you got your executive management from an example, Walmart's executive management. They come from Arkansas. They come into Texas. They've got to see so many stores and so little time, and they'll spend the night at the hotel, a hotel nearby, their one of their stores, and they'll pay the money for it too. And for as corporate relations are concerned, that's where their franchises helps as well. They usually half the time that the if it's a large enough corporation like Boeing or somebody, they've got pre-negotiated rates for Boeing. Um, Another aspect would be federal rooms. Like when any government agency, federal government agency comes into town, they usually book 10, 15, 20 rooms at a time. So,
Okay.
um, but and I guess that's could be a signal to tell me to move along.
Yes.
All right. On new development opportunities, there are a few things you got to consider. Franchise availability. Majority the more on the majority of franchises these days, they like new construction and interior corridor. Interior corridor versus exterior corridor means basically you have access to the room by walking through halls or driving up to your door. That's what I mean by exterior corridor. But yes, back to franchise availability. My one of my more favorite ones is probably the three is probably IHG, Choice, and Hilton. Marriott is starting to gain a little bit of momentum on the limited service market, but the big players have been historically have been Choice, IHG, and Hilton products, and I can probably elaborate that more later. But research on, I'm sorry, Kavita, you're going to ask me something.
Yeah, question on the research, the demand drivers, is that something you do or is that something the franchise provides you data on?
It's something we do because the franchise they will do their I guess actually both of us do it, but the initial research is done by the property owner or people that wants to seek that
Mhm.
opportunity. So then I go to the franchise and ask the reps of that area, ask them, will this work for you guys? So when I say that, is you look for what are demand drivers in the area, is there a couple of corporate accounts that would need um, a hotel nearby, or if the corporations are growing, if there's large venues. So venues, I'm talking about a wedding venue to stadiums like AT&T Stadium to Dallas Maverick Stadium. I'm Dallas Maverick American Airlines Center to schools like a University of Texas in Austin to TCU nearby.
Right.
So there's multiple drivers, but when you look at the demand drivers to what kind of rates are in the area, and what's your competition like. So if you got 10 limited service hotels, but not a single extended stay hotel there, then that'll be a perfect option to put an extended stay product there. If you got 10 extended stay products there, but there's no luxury hotel like a Marriott, it'd be, I guess, the new signature Marriott they have right now. That'd be ideal for that market, because as people are looking for a luxury, when you have that much inventory at 10 hotels of extended stay, or um, they someone would want that.
So, what kind of royalty or percentage of profit goes towards the franchise? Is there a certain percentage?
Yes, there is. So majority of franchises charge about 13 to 15%. So I'm glad you mentioned that. So my formula has been that whatever the franchise charges, you want double that in contribution from the franchise. So as I mentioned, 15% is part of the norm for most of the franchises. I want so if the franchise charges me 15%, I want 30% of my inventory to be sold by the franchise. So me, by simply opening my doors, doing no marketing, nothing else, just operating the hotel. That's where IHG and Choice and I guess in Hilton they deliver on. In North Texas, right now, IHG delivers on that same just rule of thumb, call it, is that they deliver in the 40s, 40 to 45%, 48%, 50% pushing. Hilton pushes a little bit higher, probably 50 to 60, but also yeah, get higher rates. Choice delivers upper 30s, 38, 39 to low 40s.
Okay,
So that gives you an idea. Um,
great.
so I'm sorry I'm getting carried away. Apologize.
Yeah, I think we can move on.
All right. I'm sure everybody has a lot of questions, and by all means, we can ask towards the end here. So, all right.
Yeah, we'll get to the questions later.
Okay.
So I think we were on that size would depend on ADR and occupancy demands.
Yes. So size, what and goes back to what demand drivers are. So kind of touch base on that. Size, you don't want to put a 200 or 300 unit property in a small town, and where um, that's you're never going to fill that up, or get to a level at least in high occupancy, 90% levels. Um, and so, but also on the flip side, you don't want to just build a 30 unit hotel that you'll fill up quick, but your cost of operations in the area is high. So that being said, kind of just I just touched base on the two options. So if we go too small, we'll drive up costs and constructions. So some things are construction costs. Some things are fixed, like price of concrete, price of lumber. That's going to be there. Um,
So how do
so
you research the occupancy demands? Like, how do you know what the I mean, let's say you go in and try to do a new development.
yeah.
Where are you getting your data on what level of occupancy you can have in that market or submarket?
Oh, well, that's where the research comes in. As it goes back to demand drivers. So do you look around what's there, what's coming? I mean, I spent days on research in terms of talking to local chamber of commerces, the city officials to find out what's coming in the area, um, to local schools if they're expanding their programs, venues if they're just combine that research and then um, just do online research as well, like what the rates are calling for in there. And obviously, you got to keep in mind that comparative the flag you want to get versus what's already there. So if I've got a lot of good tier or high tier flags, and see what they're collecting. And now, on that same note, you don't want to justify it just by looking at one day what the hotel did. You want to see the history,
Right.
weekends to corporate. I mean, some hotels are driven off of the summer season. Some hotels are transient properties, meaning that they're highway driven, so most of their business comes from the highway, people driving by. Other ones have corporate businesses. They're right next to um, a company or like three or four companies that constantly need their business. So,
Got
uh,
it.
but
I think we can move on.
okay, no problem.
Yeah,
Sorry.
no worries.
Um, so on, I guess, as far as the returns are concerned from your passive investors, just a form of value add opportunities, the range can 12 to 20%, no, over 20%. And the reason that is there, it was over 20%, is that depends how you get the deal. If we get the deal, I guess call it a really good deal in terms of like a well below market. And flip side, um, also when we do the research in terms of how much money it will take to renovate the property or get the property up to the standards what the franchise wants. We can forecast for higher, but it turns out that like for example, we budget for $1 million, but you only end up spending 600,000. Well, that's $400,000 less you spent on a project, which your dollar goes a little further, and you turn the flag on to where you're collecting the higher cash flow early on and at the higher rates and higher occupancy levels. But yeah, going back to the slide itself, what I just said goes down to the total returns and IR as well. Um, on the new development aspect of it, it's a little bit tighter, but reason being is that it just you're going to be a brand new hotel, so it'd be nice and exciting, and also new inventory on the market. So you're going to take away from other hotels as well when new inventory comes into play. And also just as it ages, but new development has always been, I guess, more exciting to me because it's something erecting off the ground to cash flowing. And going back to what I was saying earlier, that if we the cost of I guess in this case construction ends up being less than expected, and you guys were able to acquire the property, land itself, or partition the land from the owner or the seller at a much lower cost perspective, then return on our investment is going to be higher. So
So would you say there are less surprises in new development? Generally, we consider new development to be more risky and more prone to budget overruns. So would you say in your experience that new development is actually better than doing value add opportunities because you don't know what you're buying into?
correct. I do like that. So with that being said, yes, to answer your question, new development, there's no hidden pipes, no surprises on no, I said no, but there's very minimal surprises in development on a ground of construction. So your contractors, they know what they're going in, finish their work and get out. On value add renovations, I guess, which a lot of people can invest on this webinar, that invest in the multifamily for renovations, they can attest to that. There are always surprising expenses that we didn't know about, from a underground water leak that's probably a 30-year-old water line, to foundation issues, to roofing that it looked that was 5 years old but turns out to be 10 years old, and something
Gotcha.
happened. So
Okay.
um, on our typical hotel deals, it does go like in which, sorry, um, we pay 7% preferential interest on the return, and then do a 60-40 split. Meaning 40% goes to the sponsor, 60% goes to the investor. No, sorry, go ahead.
So I had a question there. So the 60-40 is pretty high compared to multifamily. For example, we typically see maybe 80-20 or 70-30. So could you explain a little bit about why that higher split? I know it's justified because hotels are a lot more work. Can you talk about how or why?
So to start off with, as I mentioned before, the hotels, a 100-unit hotel will take, most like the 100-unit multifamily will take 5 people to run, maybe seven. A 100-unit hotel will take 20 to 25 people to run. With that being said, there's much more management involved in the hotel, um, and there's a lot more legwork. In the multifamily space, I feel like you're just answering to your clientele that comes in, and even then, it's on an occasional basis. With the hotel, we got new clients in practically coming every day. Plus, I got to deal with facing the franchise. They love, which they love to do, surprise visits. and inspections to city officials to other asset state inspectors. So there's multiple elements going on in the hotel. With
Mhm.
that being said, there's much more management, and that's where I would say that it takes a little more time and I guess efforts to make sure that the asset is properly performing on that. So I went to that's where the 60-40 splits comes in. I've
Okay.
done I've seen 70-30 splits as well on value add, and they're there, um, and that's where I guess it depends on the deal. But
Right. And new construction is generally higher because there's more work involved, right?
exactly.
But can you talk a little bit about what's the difference in asset management? What pieces are managed in as an asset manager and what is managed by the property management in a hotel? Because I know how that translates to an apartment, but I'm not really sure what that means in a hotel. Like what pieces do you handle as an asset manager versus a property manager?
So property management, their job is to be the boots on the ground in terms of hey, there's a basically a couple main positions that they oversee is a general manager and director of sales, and then obviously property manager as well in terms of any one of the franchises or surprise inspections that can make sure we pass to city as well, city level, um, and to make sure they're properly performing on the general manager. The asset manager is basically managing the property manager. And from that aspect is okay, get that the reporting, make sure have weekly meetings or monthly meetings with the property management company. Make sure the expectations are met. If there's a drop in revenue or drop in ratings in terms of like star ratings or customer service reviews.
Mm-hmm.
Why is that? Also, asset management is going to deal more with the bank in terms of lender is concerned. Property management won't be as involved. Banks want their profit and loss and bank and just basically financials that the lenders want.
Okay.
The asset management piece to the franchise is also basically on the make sure the bills are paid constantly. Obviously, the franchises they want the royalty checks, so that's their aspect.
Okay.
And then meet in the middle, construction. That's just um, going back to like you said earlier. There's a lot more involved with the when you deal with the franchise, multiple people in terms of construction the hotel.
So the construction management, is that only for new development or is that for value add as well? Like, is there some other fees that you charge for a value add opportunity?
No, when I say 2%, it's include. Correct. For us, we do the same thing on value add as well. So if there's $1 million in renovation, then we manage that for at 2% cost as well. But
Okay.
and obviously we try to put a contingency for surprise costs on rent value add because there's usually there is. So
Okay.
all right, and this is a gives a kind of snapshot into the investment world of hotels. Hotels can and has delivered like on a 7% cap over three times their return. And as you just see, is like 12%, and that's on the low end for as a cash on cash return. That can definitely go up to next to 15, 18%. And then on the year, obviously based on that IRR, 19% is
Okay.
definitely a good number, but it can definitely go up.
So we have about 5 more minutes. So I'm going to skip to the next one. I think there were some questions around risk and risk mitigation. So I want to make sure that we cover this slide.
Okay, yes. So value add has benefits where there's low acquisition costs to counter the punch list that the franchises will require. Value add does have cash flow from day one. However, sometimes this is not always the case. Sometimes the hotels might need to be shut down for extensive renovations. Disadvantages, as we talked about a couple of times throughout this webinar here, that yes, surprise expenses. I mean, I had one case a while back that the state came in and told me my stairs, each step between the stairs, there's too much distance. So There was $100,000 steel and welding expense that I was not expecting, but we had to be done to satisfy the state, return satisfy the city, and flip the switch for the franchise. So there's stuff like that. New development, as mentioned before, very little on surprise expenses. You move the dirt, found it rough grading, put the foundation in, put the plumbing, steel, concrete, go up with steel frame construction if it's 5 stories or higher, or below it's wood frame construction. Um, and also, bottom line is, it's all towards the end here. The last point is that more franchise options are available for newer properties, and I say that with utmost confidence. But Hilton, IHG, they love brand new properties. Choice Hotels likes they don't like they do like brand new properties, but they also have appetite for conversions as well, which means value add.
So
Takes
how do you mitigate the risks in both of them? Like in value add, what are some of the ways you mitigate the risks? Like, do you do due diligence on a property? I'm assuming you do due diligence to
yes,
figure
yes.
out what are the possible problems. You have thorough inspections of all the units or doors or whatever you call it.
Yeah, thorough inspection of the units, walking every single room.
Hmm.
If you can obviously be in a hotel that there's a very small chance of you able to walk every room, but on day one. But the ones you miss, obviously schedule another day. But yes, get to walk the entire property, and go through the list, make sure everything's good. Testing everything from plumbing to electrical, fire suppression systems, mechanical systems like HVAC, have a roof checked, um, and then of course make sure you have your punch list handy if you've already talked to the rep of the franchise you want to go for. Um, and as part of my due diligence, I guess I've been doing this for such a long time that I know what franchises will need and
Hmm.
what they want and what I can have waived. I know sometimes franchises have a tendency to push when it's unnecessary, and that's where experience comes in play.
Gotcha.
So,
I think we should go to the questions. We're almost at 8:30, so lots of questions here. So let's get started with the questions. I'll start with the first one because I think this is top of mind for everyone. How is Airbnb impacting the hotel industry? What's been your experience?
um, Airbnb is, I know, I guess a lot of people have that impression that it's impacting, but it's not digging into the market much. So the Airbnb clientele is what I've seen it from coast to coast is that they want large gatherings in one place, and two, have the ability basically turnkey the property themselves in terms of, okay, making their own bed, having they can use the same towels for a whole week, and have an ability to cook together in a kitchen somewhere. That's that market. For just a one family or a couple families getting together at a hotel that they don't want to mess with anything in terms of, hey, I want to go to my vacation spot or go to my corporate event, check in, put my bags down, do my things, shower and get rested, but not worry about cleaning a room, not worry about getting breakfast. Um, so that to answer your question, the Airbnb is partaking a little bit, but not a significant piece of the market.
So, if you
Very
had
little.
to, from your own experience, since you've been in this business before Airbnb came in, what would you say the impact is if you had to quantify it? I know that's a hard question, probably.
That's probably a hard question. I've get asked that more than anything, but that's probably, I'll say, single digit percentages.
Okay.
So anywhere from 3 to maybe 8% at most on a
Okay.
market. It's very little because, like I said, different type of clientele that wants to go that.
Okay. There are a lot of questions. So
Sure.
what is the biggest risk of this asset class? And how do the economic factor influence the returns?
Economic factors. I mean, I guess everybody can say that 2008 was probably one of our toughest recessions we've had in quite a while.
Hmm.
Um,
How
back
did you weather the storm, or did you weather the storm?
we did. It was tough. I'll admit to that. We had to drop back our rates almost 40% to help to maintain the occupancy levels.
What is
Um,
your break even generally? Like how were you able to even break even at that
yeah,
point?
we were. The good thing about hotels versus multifamily, our break even is usually much lower. So I can break even at 40% occupancy and have a probably an ADR probably 20-30% below market, and still
Sorry,
have.
what is an ADR?
I'm sorry, and I apologize. I should have average daily rate.
Okay.
Average daily rate, and I apologize for that. This is where my been in this for too long. Taking
Right.
it for granted. Sorry about that.
No worries. I think we answered this one. How much royalty or percentage profit goes to the franchise? And was that 15% of the gross revenue or
Yes,
how? Okay.
it's
So
every
that
top
was a
lines
question.
out. Now, and most franchises, they will do only rooms only. So if you have a restaurant or a snack shop or a lounge on site, they usually don't touch that money. So only the
Okay.
room itself. So,
Got it. What is the typical value for a 100-unit property, new versus value add, and how much money do you typically raise?
so the new ones, brand new, they cost anywhere from the 90,000 to $140,000 a door to develop. That includes land for soft costs like architectural engineering, flag fees, like for securing a flag, to city fees and building permits, all the way.
And what about the value add ones?
Value add,
And I assume this is a lot location dependent. I mean,
yes,
I imagine it wouldn't be 140 in like El Paso or,
correct,
some other market. Yeah.
exactly. So, and the value add, that's going to depend hugely on the type of market and how good of a deal you can get on it.
Mhm.
I mean, if you take a property for like a 100-unit property, for example, $1 million, but if it needs $3 to $4 million of the work, because the city around there is adamant about, hey, and I'm giving you just a scenario: the property that's built in 1970s, that has been brought because probably grandfathered in. It's been going downhill for the last 5-10 years. So finally, the city comes in and say, hey, they find a new owner, but before they approve the new certificate of occupancy for the owner, the city tells you, hey, we got to do A, B, and C. Bring it up to, I guess right now it's 2015 IBC, which means International Building Code, um, for those new to the development,
Okay.
and also a franchise, what the franchise requires. So there's, and
So
it's
when you say 89 to 140, you mean like a tier one market, like Dallas, or is it more San Francisco? I'm trying to understand what the 89
that's
to
where
140 means.
it's probably more Dallas, San Francisco, something like that. Or probably
Way much higher.
much higher, probably like I would say 160 to $200,000 per door.
Okay.
So a 100-unit property can easily end up costing $20 million, if not higher.
Got it.
For a just and on that value add, and I guess add one more answer one more question. I'm sure people have it. Um, the capital I'm raising is usually about 30% of the project, 30 to 40% of the project. As I mentioned before, the hotel is a very management intensive asset class. So you want to have the right management. But with that being said, lenders and banks, I'm putting banks in there as far as lenders, they usually want 30 to 40% down on the project. I'm able to get a little bit less down, depends with the experience and the right flag on there. But when I say less down, that's I'm still talking about 25% down. And
And that's pretty typical even in apartments, right? Like we are looking at a 75 loan to value or maybe an 80 loan to value in some cases, but we still have closing costs, which then adds about 5 to 6%.
exactly.
So we are right about the same range. Are the loans similar in terms of being agency loans, or who are the typical lenders?
Uh, Typical lenders are local banks that do it, and then there are bigger banks that'll touch bigger loans, and then behind that you get CNBC, CNBC, CMBS.
CMBS.
Yeah, sorry, I can't spit that out. But to answer your question, agency loans do not touch hotels because it's
Okay.
not considered
And
as.
so is that a recourse or is that a non-recourse loan?
Um, it's been half and half. More lately, it's been more recourse since the recession. But I've seen some more opportunities here lately that non-recourses are available. And now, as far as the rates are concerned, obviously non-recourse rates are usually higher than full recourse. I've seen rates low as fives, forward and fives for full recourse and non-recourse, like low as six or seven. But then also it goes on top along with the loan size. $1 million loan to a bank is they can charge 8%, but $10 million loan they'll probably charge 5%. So because for them it's the cost of doing business. It takes the same amount of legwork from that to underwrite it, service a loan on $1 million loan versus a 10 million. So that's
Got it.
what.
And the other question is, what is the soft cost versus the hard cost percentage breakup for new construction?
Soft costs I put generally for the overall budget. I usually try to gauge about 3 to 5%. Probably 5% be safe. And soft costs, and when I include that is securing the flag. Most flags charge anywhere from about $50 to $80,000 just to have the rights to a name plus the royalty. Second piece would be securing the architect and the engineers that go along with like structural, plumbing, electrical, mechanical, fire suppression systems to civil engineers, whatever the case may be. That's one aspect of it, and another aspect would be permitting, like city impact fees, building permit fees. That's generally um, that's kind of the bulk of it, of the
And
soft
the
cost.
hard cost?
Hard costs is obviously I'll put a 90, probably 80%, 80, 90% of that, and then actually probably close to 80%. Because after you do the soft costs, 80% of hard costs in terms of actual going to doors building ready, but the remainder 10% is probably going to go towards FF&E, like furnitures. Like obviously, that's another differentiator between multifamily and hospitality hotels that you're providing the beds, you're providing the dresser, you're providing the intake,
Right,
all the furniture that goes in the room,
right, right.
and in the common areas. So that's you got a budget for that.
What
Um,
is the lead time from proposal to opening for a new development?
Lead time is typically about I'll say about 12 to 15 months from the point you acquire the land to the point you actually open doors. So I'd say 15 months because you're going to take about average 3 months. My experience has been is that you get to have the architects and engineers develop the plans. They expect a couple of weeks. They send it to the franchise for review.
Hmm.
And like a good old school grade teacher, they take a red pen and mark it up. And hey, you got to correct A, B, and C, make revisions. The franchise sends it back to architect and engineers. Their engineers and spend about a week and a half to make the revisions to the plan, send it back to franchise.
Okay.
80% that's 80% they sign off on it, but at this point in time, a month and a half has passed. And once the revisions are approved, the whole entire package goes back to architect, and phase two of that go back to the whole process, except this time with the city. So they go through it, make their comments, and they send us back, and
So
then
this 15 months you're talking about is including all the permitting and
yes,
everything, the whole process. Okay.
yes, exactly. Include all that, and then get all the everybody lined up. And once the first set of revisions come back from the city, the revisions are sent back for the second time, second review.
Hmm.
At that point in time, we ask for a second set from the architect so we can start finalizing the bids for the subcontractors, start laying out a schedule for as which contractors is coming when, and expectations, and then obviously pay schedule for the contractors, and then get the lender updated as well. For
Okay.
So that's that aspect.
I think we have time. We're 10 minutes over already. So I'm going to see. Okay, let's talk a little bit about really quick about any tax advantages. That'll be pretty similar to multifamily, right? You're basically taking advantage of accelerated depreciation,
Correct.
first year depreciation.
Yes.
So typically, what do you see in terms of a depreciation? Let's say I do a 100K investment. How much am I depreciating? Like in apartments, we're looking at about, depends on the deal, right? Like if the land value is high, then we might see it on the lower end because you're basically depreciating only the improvements. So what is a typical depreciation that a person can expect for a $100,000 investment?
Oh, we kind of hit the nail on the head there. Yeah, it depends on the value add. It depends on the property. I mean, you
Is
can
that a
go.
range we can look at, like 30 to 80, something? I don't know.
Yeah, that's. I was actually exactly say exactly that. But I would say about 40 to 80 would be a good range. Um, the on a new construction, it'd be closer to the middle of that because and I tell people that we kick the depreciation, and once we start generating revenue that way, we can offset the cost of tax liability on that year one. So obviously it goes down from there. But to answer your question, yes, there'll be huge tax benefits on the hotels as well, just similar to multifamily. So
So I think there's another question about, are there any specific sites? I think we'll close with that. I don't think unless people want to stay late, the other specific sites to research on hotel demand. Like as a passive investor, they want to check on a certain area that they're presented with a hotel investment. How do they research the demand?
just I mean, city websites are usually pretty good. I mean, I know like example like Amazon when they announced what's coming in the area. Um, I mean, if you get another example, if you see a Walmart, I don't know if well, most people know this, but like a Walmart example is that when they go in, 90% of the time the land is donated to them or given to a substantially lower price. Reason being is that they know all the other businesses they bring to the area. So every time Walmart goes in, example, they know they bring 20 or 30 other businesses in the area. And that being said, those businesses they have inspectors, managers, all that they kind of corporate travel. A hotel will need me come into play. So that's one thing aspect I can say for as any development to watch the news of what's new industries. And I know I'm using more primary um, players in the as far as corporate business, but there's tons of, I mean, I mean, thousands of businesses out there, like industries that are behind the scenes um, that still need for hotel accommodations.
So I think what you're saying is sort of look at the demand drivers, and if there are enough there generating jobs, then they should need hotels at some point to house their personal or traveling people.
And another example is that multifamily. If you see a multifamily come into play, like a 200 or 500 unit multifamily, uh, my hotel is going to be needed there because just like in multifamily that a unit's turned, you got a family that's moving in the area, but the units aren't ready, they need a place to stay. To opposite side, like when someone needs to move out, but their new place across town or across country, it's not ready. They need a place to stay. So,
Got
uh,
it.
but that's one aspect. But
Yeah, I think we can wrap up with that. Thank you so much for your time, Chirag. I appreciate your time and effort you put into this. So I hope everyone that was useful. And I'm sorry we ran over. I always do. There are so many questions to get through. So
um,
thank you all.
thank you. And I guess should we give our contact information if anybody wants to contact us? Or?
Yes, yes. If anyone wants to contact Chirag, do you want to just, I don't think
Yeah.
I have it in the presentation.
No, but
So
by all means, I can do it. Give it to you. So my name is Chirag Patel. I can be reached at with the email at Chirag CHIRAG at jrchotels.com, or you can contact me directly at 817-797-7102. And I'm going to put in the chat window as well. I guess I'm seeing that this helps. And by all means, shoot me a text or give me a call. I'll be more than happy to talk to you guys. And again, Kavita, thanks for having me. So
thanks for being on. Thanks everyone for joining. Sorry we ran over, but hope that was useful. Until next time, we will be talking for the next webinar on cost segregation and depreciation. So that'll be an interesting topic for folks investing in multifamily hotels, any of them. That's where really we'll talk about how depreciation is different in multifamily and other commercial investments that you can really take advantage of for those tax savings. So stay tuned for our next webinar. Thanks to Dave for joining. Have a great night. Bye-bye.
Thank you, everyone. Have a good evening. Thank you.